A guy retires at 62 with a pension paying him $3,000 a month. His neighbor retires the same year, same age, no pension. 5 years later, the pension guy is stressed about inflation, eating his fixed income. The no pension guy is sleeping fine because his portfolio adjusted. 10 years later, the pension guy is watching his buying power evaporate while his neighbor's dividend income grew 40%. Same retirement age, same lifestyle goals, completely opposite stress points. Here's what nobody tells you. Having a pension doesn't just give you money in retirement. It fundamentally changes which financial problems you have. And most people with pensions are still following advice designed for people without them, which is why they end up blindsided. So here's what I'm going to do. I'm going to explain how the entire retirement equation flips when you have a pension, why the standard advice about 60-40 portfolios and the 4% rule might actually be backwards for you, and how to think about the single biggest financial decision you'll probably ever make, the lump sum offer. Because once you understand the incentive structure behind pensions, you'll realize you've been playing a completely different game than most retirement advice assumes. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the central concept you need to understand. Retirement with a pension versus retirement without a pension isn't just a difference in degree, it's a difference in kind. Think about it like this. One person is playing poker, the other is playing blackjack. Same casino, same chips, but the optimal strategy for one game will bankrupt you in the other. A poker player counts on psychology and reading opponents. A blackjack player counts cards and plays pure probability. Use poker strategy and blackjack and you're toast. Use blackjack strategy and poker and you'll get cleaned out. Pension versus no pension is the same split. Different games, different rules, different risks. And here's the thing, most financial advisors are teaching you blackjack strategy when you're sitting at a poker table. Let me show you what I mean with the first big shift, investment allocation. The conventional wisdom says that at retirement, you should be 60% stocks, 40% bonds. The logic is straightforward. You need growth from stocks, but you also need stability from bonds because you're withdrawing from this pile every month to live. Standard advice. But now add a pension into the mix. Let's say your pension plus Social Security covers 80% of your living expenses. Suddenly, your investment portfolio isn't your lifeline anymore. It's your surplus, your mad money, your legacy fund. And this is where it gets interesting, because the math says you can go in two completely opposite directions and both make sense. Direction one, you can get way more aggressive. If your pension covers your baseline living costs, your portfolio doesn't need to be defensive. You're not selling stocks in a down market to buy groceries. You can ride out volatility. So instead of 60-40, maybe you go 80-20 or even 90-10. You're not gambling with your food money anymore. You're playing with house money. I know a guy worked for the state for 30 years, retired with a pension covering his entire nut. He's got his 401k sitting in 100% equities. If the market crashes 50% tomorrow, he's annoyed, but he's not broke. He's got time to wait for the recovery because his income doesn't depend on his portfolio value. That's the aggressive play. But here's the twist. Direction 2 says the exact opposite, and it's just as logical. Some people look at their pension and Social Security and say, I've already got my guaranteed income covered. Why would I take any risk at all with my savings? So they flip the allocation the other way. Instead of 60-40, they go 40-60 or 30-70. Mostly bonds, maybe some cash. Their thinking is that the pension is already their stock-like risk. It's just wrapped in a different package. They've already got longevity risk covered. They've already got baseline income covered. The portfolio becomes pure preservation, no drama, no volatility, just a cushion for unexpected expenses and legacy wealth. And mathematically, this makes sense too. So you've got two opposite strategies, both rational, both dependent on the same input. Having a pension, the problem is, nobody tells you this choice exists. The financial advice industry just parrots the 60-40 rule like it's physics. It's not. It's a starting point for people without pensions. If you have one, the entire calculation changes, and you need to actively decide which direction makes sense for your psychology and your goals. Now, you might be thinking, okay, but at least the pension gives me stability, right? Fixed income every month forever. That's the whole point. And yeah, that's the sales pitch. But here's where the poker versus blackjack metaphor really kicks in. Because pension income isn't actually stable. It's a melting ice cube. Let me explain. Most pensions, and I mean the vast majority, do not adjust for inflation. You get the same dollar amount in year 1, year 10, year 20. Social Security has a cost of living adjustment. Your pension almost certainly does not. So let's run the numbers. You retire at 62, your pension pays you $2,000 a month. That's $24,000 a year. Sounds solid. In year one, it buys you $24,000 worth of stuff, obviously. But let's assume a conservative 3% inflation rate. Not crazy, not hyperinflation, just normal, boring, historical inflation. By year five, that same $2,000 monthly check is only buying you the equivalent of about $21,000 of goods and services in today's purchasing power. You've lost roughly 12% of your real income. By year 10, you're down to around $18,000 in real terms, a 25% haircut. By year 20, that $2,000 check is buying you what $13,000 bought when you retired. You've lost almost half your purchasing power, half, and you can't do anything about it. The check doesn't grow, your expenses do. Here's the kicker. The no pension retiree doesn't have this problem, or at least not the same way. If you're retired and living off a portfolio of stocks and bonds, your portfolio has a fighting chance to grow faster than inflation over time. Stocks historically outpace inflation. Dividends increase. Even bond ladders can be restructured as rates change. You've got optionality. The pension retiree has a fixed contract with a depreciating asset. It's like buying a car that loses value every year, except you can't trade it in. Now, to be fair, you didn't pay for the pension with your own capital in the same way. Your employer funded it as part of your compensation, but psychologically, this is a huge shift. Early in retirement, the pension feels like freedom. 20 years in, it feels like a trap. I've seen this firsthand. I know people who retired in 2000 thought they were set with a $3,600 monthly pension, and by 2020, they were feeling broke because their real income had been cut in half by inflation, while their property taxes, healthcare costs, and everything else doubled. They didn't get poorer because they made bad decisions. They got poorer because the math of a fixed pension is designed to make you poorer. It's not a conspiracy, it's just incentives. The company or government that promised you that pension did the math. They know inflation will erode their real obligation. That's part of why they could afford to offer it. You're holding the risk. This brings us to the decision that keeps pension holders up at night, the lump sum offer. Here's how it works. You're about to retire. You've got a pension that'll pay you, say, $3,000 a month for life. Then the company comes to you and says, or we can just give you $750,000 right now. One check, walk away, no more monthly payments. You handle it. And suddenly you're sitting there with a calculator and a knot in your stomach trying to figure out which option screws you less. Because both options absolutely can screw you. Let me break down the incentive structure, because this is where the game theory gets really interesting. The company offering you this lump sum has done the math. They've calculated your life expectancy down to the month using actuarial tables. They've factored in investment returns, inflation, and their own cost of capital. The number they're offering you is not random. It's the present value of their expected future obligation to you, probably discounted a bit because they're hoping you'll take it. Why do they want you to take it? Simple. Risk transfer. If you take the lump sum, you now own all the risk. Longevity risk, meaning if you live to 100, that's your problem, not theirs. Investment risk, meaning if the market crashes and you lose half of it, that's on you. Inflation risk, sequence of returns risk, healthcare cost risk, all of it shifts from their balance sheet to yours. From their perspective, this is a beautiful deal. They get to close the liability and never think about you again. They can book it as a win. From your perspective, the math is way more complicated. Let's use real numbers. $3,000 a month is $36,000 a year. The classic 4% rule says you can safely withdraw 4% of your portfolio per year in retirement. So if you need to generate $36,000 annually, you'd need $900,000 invested. But the company's offering you $750,000. That's a $150,000 gap. If you take the lump sum and try to replicate the pension income using the 4% rule, you're going to come up about $1,500 a month short. You'd need to either accept a lower withdrawal rate or take more risk to generate higher returns. Now, maybe you think, I can beat 4%. I'll do 6%. At 6%, that $750,000 generates $45,000 a year, which is actually more than the $3,000 monthly pension. But here's the problem. To reliably get 6% annually, you're taking significantly more risk. You're probably heavily weighted towards stocks, which means in a down market, you might have to sell at a loss to maintain that income, which accelerates the depletion of your capital. And if you die early, let's say at 70, your heirs get whatever's left of that $750,000. If you took the monthly pension and died at 70, the payments stop and your heirs get nothing unless you elected a survivor option, which would have reduced your monthly payment. So the lump sum gives you legacy optionality. The monthly pension gives you longevity insurance. It's genuinely a values-based decision disguised as a math problem. But here's what almost nobody tells you. The lump sum offer is often objectively worse on paper, but people take it anyway because of psychology. There's a concept in behavioral economics called present bias. Humans are wired to overvalue immediate rewards and undervalue future payments. $750,000 sitting in your account right now feels more real, more tangible, more secure than the abstract promise of $3,000 a month for the next 30 years. Even if the math says the monthly payment is worth more in present value terms, your brain is screaming, "Take the money now." The pension system knows this. The whole lump sum offer is designed to exploit your cognitive bias. They're literally betting that you'll make the psychologically satisfying choice instead of the mathematically optimal choice. And millions of people do. They take the lump sum, feel rich for 6 months, then slowly realize they're now managing a portfolio they don't understand, taking sequence of returns risks they didn't anticipate, and lying awake at night wondering if they made a catastrophic mistake. I'm not saying the lump sum is always wrong. For some people, especially those with health issues or strong investment discipline or a deep distrust of their employer's solvency, it's the right move. But you have to go in eyes open. You're not just choosing between two payout structures. You're choosing which set of risks you want to own. Let me give you a concrete case study, so this isn't all abstract theory. Two guys, both 58, both engineers at the same aerospace company for 30 years, both about to retire early. Guy A, let's call him Tom, has a pension that'll pay him $4,000 a month starting at 60. He also has $400,000 saved in his 401k. His Social Security at 67 will be around $2,000 a month. His monthly expenses are $5,000. Guy B, let's call him Steve, worked at a different company, same salary, same career arc, but no pension. He's got $1.2 million saved in his 401k because he was maxing it out his whole career, knowing he didn't have a pension to fall back on. His Social Security is also about $2,000 a month, same $5,000 monthly expenses. At first glance, Steve looks way richer. He's got $1.2 million versus Tom's $400,000, but let's run the math. Tom's pension of $4,000 a month is worth, using the 4% rule, about $1.2 million in present value. So Tom's economic position is really $400,000 in savings plus the equivalent of $1.2 million in pension value. That's $1.6 million in total retirement wealth. Steve's at $1.2 million. Tom's actually ahead, and his position is safer because $4,000 of his $6,000 monthly income at age 67 is guaranteed. He's not selling stocks in a bear market to eat. Steve has to draw down his portfolio from day one, which means he's taking sequence of returns risk immediately. If the market tanks in year 2 of Steve's retirement, his portfolio might never recover because he's pulling money out at depressed prices. Tom doesn't care. His income is locked in. But, and this is a big but, 20 years later, Tom's $4,000 pension is buying him maybe $2,500 of goods in real terms because of inflation. Steve, if he managed his portfolio well, might have seen his principal grow despite withdrawals, and his income could have increased. So early in retirement, Tom has the advantage. Late in retirement, if Steve didn't screw up, he pulls ahead. Different games, different risks, different optimal strategies. And here's the part that nobody wants to say out loud. Having a pension changes your identity as a retiree. It changes how you think about money. When you retire without a pension, you're forced to think like an investor. You're managing a portfolio. You're making decisions about asset allocation, rebalancing, tax loss harvesting. You're engaged with the market. You're thinking about compounding and dividends and capital gains. You're, in a sense, still in the game. You're an owner of productive assets. But when you retire with a pension, you're thinking like a pensioner. You're waiting for a check. You're passive. You're on the receiving end of a bureaucratic process. And psychologically, that's a huge shift. I've watched this happen. People who spent their careers being competent, decisive professionals retire with a pension and suddenly become weirdly dependent. They lose the edge. They stop thinking about wealth creation and start thinking about preservation. They stop asking, how do I grow this, and start asking, how do I not lose this? And look, maybe that's fine. Maybe after 30 years of grinding, you've earned the right to coast. But I've also seen it make people soft. They stop learning, they stop adapting. They become the guy at the coffee shop complaining about how things used to be better instead of the guy figuring out how to thrive in the new system. The pension mindset can be a trap. It can make you a renter in your own retirement instead of an owner. Here's another angle nobody talks about. The pension company's incentive is for you to die early. I'm not saying they're rooting for your death, but structurally, mathematically, their best financial outcome is that you collect fewer checks than they projected. If you retire at 65 and live to 90, you collected 25 years of payments. If you retire at 65 and die at 73, you collected 8 years. Guess which outcome was better for their balance sheet? The monthly pension is longevity insurance for you, but it's longevity risk for them. They're betting you die on schedule. You're betting you live longer than schedule. It's not personal, it's just how the math works. The lump sum offer is them trying to buy out of that bet. When they offer you $700,000 instead of the monthly checks, they're essentially saying, "We'll pay you now to take the longevity risk off our books." And for them, that's often a good deal because they've calculated that the average person who takes the lump sum will either spend it down too fast, invest it poorly, or die before it would have been more valuable than the monthly payments. They're playing the odds. The question is, are you the exception or the average? And then there's the tax angle, which almost everyone screws up. Monthly pension payments are taxed as ordinary income. Every dollar you receive is taxed at your marginal rate. If you're in the 22% bracket, you're giving up 22 cents of every pension dollar to the IRS. The lump sum, if you roll it into an IRA, doesn't create an immediate tax event. You only pay tax as you withdraw. But here's the trap. If you take the lump sum as cash, not as a rollover, you get hit with a massive tax bomb. The entire amount is taxable in that year, which probably rockets you into a higher bracket. Plus, you might get hit with a 10% early withdrawal penalty if you're under 59 and a half. I've seen people take a $600,000 lump sum, get hit with $200,000 in taxes and penalties, and suddenly they're sitting there with $400,000 wondering what happened. The pension system doesn't make this clear because they don't have to. It's your job to know the rules, and most people don't. They just see the big number and think they're rich. So what do you actually do with this information? 3 things. First, if you have a pension, calculate its present value using the 4% rule and add that to your net worth. A $2,000 monthly pension is worth about $600,000. A $3,000 monthly pension is worth about $900,000. A $4,000 monthly pension is worth about $1.2 million. You need to mentally account for this when you're comparing your financial position to people without pensions. You might have less in your 401k, but your total retirement wealth is way higher. This also means you should probably rethink your investment allocation. If your pension covers your baseline expenses, you can afford to take more risk with your portfolio, or alternatively, you can decide you have enough guaranteed income and de-risk everything else. Both are valid. But sticking with the default 60-40 allocation makes no sense. Second, if you're offered a lump sum, run the numbers cold. Calculate what your monthly pension is worth in present value. Multiply the monthly payment by 12 to get annual income. Multiply that by 25. That's the 4% rule equivalent. If the lump sum they're offering is less than that number, they're lowballing you. Doesn't mean you shouldn't take it, but you need to know you're accepting a discount in exchange for flexibility and control. And if you do take the lump sum, for the love of God, roll it into an IRA. Do not take it as cash unless you enjoy giving the IRS a 6-figure gift. Third, understand the inflation risk you're carrying and plan around it. If your pension doesn't adjust for inflation and you're retiring at 60, you need to assume that by the time you're 80, your real purchasing power from that pension will have been cut in half. Build that into your spending plan. Maybe you live a little leaner in the early years and keep more of your portfolio invested for growth. Or maybe you plan to downsize your house at 75 to offset the pension erosion. But don't just assume the $3,000 check will feel the same in 20 years. It won't. It'll feel like half that. If you pretend otherwise, you're setting yourself up for a brutal surprise in your late 70s when your expenses haven't dropped but your income's real value is cratered. Look, here's the bottom line. The financial services industry sells retirement advice like it's one size fits all. 4% rule, 60-40 allocation, retire at 65. It's simple, it's clean, it's also wrong for at least half the population. If you have a pension, you're playing a completely different game with different risk exposures and different optimal moves. The standard advice isn't just suboptimal for you, it's potentially dangerous. You're following a blackjack strategy at a poker table. The fact that most pension holders don't realize this and most financial advisors don't bother to explain it tells you everything you need to know about how the incentive structure actually works. They're not trying to optimize your outcome, they're trying to standardize their process. But your retirement isn't standard, it's yours, and the math is different. I spent 20 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves. The number one thing I learned is that the rules are different depending on your structure. Pension versus no pension is one of the biggest structural differences in retirement, and almost nobody talks about it honestly. So now you know. The pension isn't just income. It's a completely different risk and return profile that changes every other decision you make. Don't work for money. Own the companies that do. And if you can't own them directly because your income's locked into a pension, at least make sure the money you do control is working harder than the pension that's quietly inflating away.